Peter Rose, Longwood Currency Trading. It's 22nd of December in 2020 that I'm recording this. I have my coffee. It's afternoon. I have no snow shoveling to do today. There's no roof raking to do, but we still have about 18 inches of snow depth out in the yard. I'll get some B-roll maybe later and run that in this section here, and you can see the snow depth chair as it indicates that we still have a lot of snow on the ground. So there's the famous snow depth chair. To the arms of the chair is, probably about 28 inches or something like that. Top of the chair is 36. The snow was up just below the top of the chair a few days ago, and you can see it's down by the seat now, which is under the arms, and the seat is 17 inches. So there's a good 18 or 20 inches of snow still on the ground out here. And I think you can see it's all, whoops, big snow hills. Big snow hills. Yep, that's what happens in New England. The other day I did a video on the reality of intuitive trading, and part of the implementation of an intuitive approach to trading is in getting out of a trade, and not at the entry point, but rather in a trade that has been progressing forward for a while and is running toward your profit target. So there's a couple of avenues of approach here that folks use. You set a profit target. I mean, in a scalping sense, you don't set profit targets. You just watch the price, and you grab a few pips and you're out, and then you cascade it up from there. That's a little bit more complex process. I use a process where, as you know, the pair that I trade has about a 5-pip ATR and a 5-minute chart, and so I've got an 8-pip stop as an entry point, and then I'm shooting for a target of 25 pips or so. And so that's the story that I will convey to you, those characteristics. Now, if you're trading a pair that has a 15-pip ATR on a 5-minute chart, none of the stuff that I say makes any sense. You have to become proportional with it. And I did a video and a blog post about calculating parameter proportionality to time frames that you're trading on, and pair characteristics. So you might want to check into that. But for purposes of argument's sake, just for discussion, we'll use the 5-minute chart with a 5-pip ATR, 8-pip hard stop, and a 25-pip target. So the price is running in your favor, and it's at 20 pips. So what does that mean? Most people would have that profit target, and they'd say, well, I got 5 more pips to go. And I think that's where you hear a lot of the chatter in the background from retail traders that, geez, it was going in my direction and blah, 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 and it turned around and turned into a loss. Got stopped out. And I think we become too rigorous at times in setting that type of scenario in our trading, to say I've got a 20-pip stop, I've got a 20-pip profit target, and that's what I'm going to get. And rather than looking at it more intuitively, we're just saying, look, the position appears as though that it has about 20 pips to run. That could mean that structure is somewhere in that 20 to 30 pip, 20 to 25 pip band. These things are all in ranges that you look at. And so I just say, well, the bottom end of that range or band should be about 20 pips. Do I really expect to get 20 pips when I go into a trade? No, I think the expectation that I have from a probabilistic standpoint of achieving the 20 pips, even though the structure is giving it, is jump ball. It's about 50-50. However, if I am able to intuitively read those structures and price action correctly, I should be able to get 10 or 15 pips. And I want to be sure that I get at least 5. So as the price moves into profit, I'm going to pull my stop and I'm going to bring it up to break even to start. And then when I've got enough distance between the current price and that 5 pip lock point that I want to lock in, and I won't go over what those are. I've got them all mathematically calculated out. But, again, I don't want to confuse people. And then you try to duplicate what I do and it doesn't work. And you go, oh, Peter Rose is full of shit. Well, okay, whatever. So you got to think for yourself on this stuff. So I've got the 5 pips locked in. So if you're trading $1,000 account, $1,000 account, then 5 pips is 0.5%, right? $5 1,000. So if I trade a $100,000 account, 5 pips is still 0.5%. So you figure out what that dollar value is. The percent remains the same, but the dollar value changes with the account size. So your anxiety level is going to go up the larger the size that your bank is, because you're trading with larger lot size. Therefore, your risk is greater in your mind. From a percentage standpoint, it ain't greater, but the dollar value is so much greater. That's why I don't advocate trading for money, trading for dollars, but just trading for pips. You got to be agnostic to what the dollar value is, or you're going to make yourself crazy. So that price is, we talked about, I did a video on momentum and looking at the momentum at trade entry point. Does price action have that special juju pixie dust in order to drive it from your take point to your profit target? Is there enough gas in the engine to get it there? It doesn't say whether it's going to get there. It just says, well, potentially it could get there. So you go in and you take the trade. As soon as you take that trade and price moves beyond that point, you have a different scenario. The landscape has changed. The conditions of your entry are gone. Because if you were to take that trade again just 5 pips later, then you may not want to take that trade at that point because the conditions may have changed. It may have done something else in the interim. So it's a new game. So to set that take profit target, that's what's potentially there for you. But is that reasonable? I think it's jump ball. It's 50-50. I wouldn't want to point a gun to my head and bet 50-50 that the bullet, that I've got 4 chambers and I've got 2 bullets in the chamber. I wouldn't want to bet 50-50 on that. And I don't think you ought to be betting jump ball trading either. So you have to manage that. You have to manage that position. The amount of money that you're going to make is out of your control. The amount of money that you can lose is in your control. So you've locked in the 5 pips profit. You've got that. So you're not going to lose any money. But if you've gone from your take point and you're at 10 pips up, and that 10 pips is profit. If you don't take it and you go back down to your take point, you've lost 10 pips. That's why you have to have stops set under you. You can't have any. You can't have imaginary stops or mental stops. And this becomes very problematic for me as a speculator, because you really don't have time to be moving these lines around. So what? And you don't have a lot of real estate that you're dealing with. So you really have to be disciplined with your exit strategy and where your new reasonable profit target should be. Those are both variables that are going to fluctuate based on what the price action is doing. You could write all the mathematics down for all that stuff, and you could come up with a solution, but you don't have time to do that. If you're if you're a longer term trader, then you do have that time, and you can make different kinds of analytical calculations, and your decisions will be different on a longer term frame. The process will be the same. It's just that you've got more time to make calculations and see how it goes. You could wait 15 or 20 pip swings before you actually make a decision as to what you want to do. If you're doing short-term trading, like I am, then your decision process, you might only want to let a chatter event, price is at 15 pips and it's kind of stagnated there, and now it's down to 17, and now it's down to 16. You may want to jump out at that point because it could go right back down to where your stop is at the protective 5 pip gain. Sure, you make the 5 pips, you make 0.5% on the trade, but you've lost 15 pips by your inability to look at that situation and intuitively say, wow, this thing is turning around. I think I'll just get out. I had a 15 pip profit, and then I was down to 13, and then I was down to 12. Bang, and I got out, and so I got 11. So now you've got 11 pips out of that situation instead of 5. So you've doubled that profit. But you didn't do that based on a rule, because there is no rule that's going to go with that. I've talked about in other videos and some of my blog posts, I've again applied momentum theory against this price that's in profit and how you do the momentum analysis, because the momentum is going to change. Momentum, again, in physics is mass times velocity. So the velocity will very easily change. And so you need to really be tuned in and watching that price. If you're scalping, you're day trading, you need to do that. Of course, even if you're trading off of the daily, you're still doing that, but it's just that you're checking it at 5 o'clock at the end of the day, U.S. time, 5 o'clock, New York time. You check your charts at the end of the day and see what it's done. And if it's, come down more than where you feel, more pips than you feel you want to lose for the day, it's based on the ATR. If you lose, like on my on my example here, where it went to 15 and then it came down and I got 11, so I lost basically 6 pips. So if I had an ATR of 100 pips, that'd be 20 times. So I'd be 20 times a 6, it'd be 120. Trying to do proportional analysis here in my head, it's not working out very good. But you can see that where I'm going to be jumping out at 6 pips, if your ATR is 100 pips on a daily chart, you may be jumping out after losing 30 or 40 pips, but you'd still be making 20 or 30, right? So it isn't something that you can codify a rule to. I mean, that's why I'm doing mental calculations here, because I don't do that. I don't do that in the trading. I rely on my intuitive view of what the market is doing and what's happening to that momentum. That momentum is not a static value that once you peg what the momentum is, it's going to continue with that. It's like shooting a cannonball out of a cannon. You know, it has that parabolic arc to it. So it's got all this momentum, mass times velocity, and eventually the resistance of the air and gravity begin to work on it, and it starts to parabolically hook over, and it's going to lose momentum. And the more momentum that loses, that parabolic arc goes to the ground. Those things are calculable because they're physical phenomena that are represented easily through mathematics. In trading, you're dealing with some whack job that, oh fuck, I got to get out of my position, I'm going to sell. And then Bob over here sees you panicking and he gets out of his position, and all of a sudden everybody's running for the door. So you can't have a mathematical model of price action, particularly on the lower time frames. That's why I think it's better to learn on the lower time frames, because you really get a sense for the trading, and you develop an intuitive sense for what price is going to do. It's very easy to map that up then onto the daily chart if you want to be a long-term trader. You know, it's like learning how to drive. If you learn how to drive a stick, you can easily learn how to drive an automatic. But take anybody who's driven an automatic and bring them down into a stick, and man, it's their bowels go in an uproar. It's very difficult for them to do that. That's why I say that the stuff that you learn and do on the shorter time frames is applicable to the higher time frames. You just have to change the proportionality of your parameters. Whereas you can't do that when you come down from trading on a higher time frame, because the world is different up there than it is down here. You have to really do it differently. Diving in the ocean is the same kind of thing. You know, if you're just put a snorkel on and you jump in the water and you swim around and you're down 10 or 15, 20 feet, yeah, that's you know, you're managing all of that, and that's all fine. But go down to 60 or 70 feet in a snorkel thing. I mean, it's different. There's different issues that are involved, and if you try to make the parameters of your shorter depth dive applicable down at the deeper dive, you're going to be in trouble. You're just, you know, trading isn't any different than any of the other things that we come in contact with in life. Our process of learning how to trade is the same as learning music. You can have notes and scales in music, and you can see the sheet music, and you can play the song, but that song will change, you know, every time you play it. It's going to be based on it. Look at, who was it that wrote the poem Trees? Was it St. Vincent Millay? I don't know, pick any rhythmical poem. Edgar Allan Poe's The Raven. I love that poem, and I read that out loud. And you can change the pacing. The meaning is the same, the words are the same, the commas are in the same position, but you can get a different flavor for that, depending on who reads it. You know, if you have a Shakespearean actor reading that, you're going to get a different flavor than Peter Rose reading The Raven to you. But why is it any different in trading? And that's all that intuitiveness and that knowledge gained through your experience and failure and trying to make it correct and to try to make it exactly like the sheet music is, or exactly like the punctuation is in a poem, until you get the point of where the author or the musician intended you to pause or to accelerate your tempo. You won't know how they're emotionally reacting to their artwork, as to how you are affected by that work. How many different versions of I don't know, Silent Night are there? You know, you listen to Bing Crosby and you listen to Boulez do it, and it's the same song, but it's a different feeling. So you have to make your trading the same way. You can't get fixated on profit targets and limit orders and all that other kind of stuff. There's certain rules that you need to apply and intuition into your trade entry, and there are equal rules and even probably more intuition, that need to go into your trade management. Just some thoughts for you. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.